I would characterize the pre-pandemic lodging environment as steady but very late cycle. And then, as everyone knows, we hit a brick wall in March 2020, massive shutdowns, stay-at-home orders, a lot of conferences, events, meetings were being canceled. So, most of these companies, they saw revenues go to zero overnight. You had a RevPAR drop 80% peak to trough, and there were significant concerns regarding cash burn rates, liquidity, near-term debt maturities, and potential covenant breaches on a lot of these revolving credit facilities. Overall, we expect a full lodging recovery probably by late 2023 or 2024, but it's definitely going to be uneven, and the mix of lodging demand could look a bit different than pre-COVID. I mentioned leisure travel clearly outperforming and in some cases exceeding pre-COVID levels in a lot of different markets. If you look at the overall July, early August RevPAR data, actually returned to pre-COVID levels, primarily driven by the strong summer leisure travel season. Within group, you have what's called SMERF, which is social, military, education, religious, fraternal, sports groups. That's basically also returned or expected to return to pre-COVID levels. And then just lastly, you have the segments where there's just a lot more uncertainty. So, things like corporate group conferences, meetings, which, you could argue could be done, pretty easily over Zoom and WebEx. Importantly, corporate transient demand has historically been the most profitable segment of the hotel industry. These customers are typically booking last minute, so they're paying higher rates. They typically have higher ancillary spend when they're on property. So there's going to be a lot of focus on how this segment shakes out heading into 2022 and beyond.
Recognizing that the downturn was not caused by excessive leverage, and having the hindsight of that post-GFC recovery, lenders didn't purge their books and take losses in high volumes. Instead, they often worked with borrowers to forbear and modify loans, particularly, again, earlier on in the pandemic. That said, there has been distress activity, and we've been able to capitalize on it. I think Europe presents a pretty unique opportunity, but the situation there needs to play out a bit longer. The opportunity set is still relatively limited due to the extensive government support for the sector since the COVID outbreak in Europe. And that's really prevented meaningful distress in the sector, despite the situation there really being far worse than what it is in the U.S. RevPAR there is still down over 60% relative to 2019. We do expect more distress to come out of Europe as that government support starts to tail off, the major brands start to really enforce their standards, and just the labor pressure on the market. We think all of these things will, on a combined basis, add some distress into the system.